So one of the most important determinations to make with respect to the tax treatment of an investment partnership is trader versus investor. So what does that mean? Well, trader versus investor is going to determine the deductibility of the fund's expenses. So what type of expenses would a fund have? Well, a typical fund would have professional fees, for example, including audit fees, administrative fees. It would have investment interest expense, and most importantly to investors, it would determine the treatment of management fees and, depending on your structure, performance fees, or what we call incentive fees. Of course, it's not defined in the Internal Revenue Code or in the Treasury regulations anywhere. Some of the characteristics of an investor fund would be infrequent trades, long-term holding period, a less robust practice for the investment manager. Conversely, a trading fund would have a much more robust practice in terms of technology, personnel, staffing. And what I typically tell my clients is it's more of a qualitative analysis than it is a quantitative analysis. Not to say that we don't have any metrics to use, because, for example, a trader fund can be measured based on portfolio turnover, number of trades in a given day, that sort of stuff. The deductions for an investor fund are going to be subject to limitations. 2%, what we call the itemized deduction limitation. The trader fund expenses are going to be completely deductible, what we call above the line. So investors are going to get a benefit from those. I'm Paul Wiley with Untitled Chapter.